Welcome to The Explainer. Today we're diving into the financial markets. And it feels like we're being told two completely different stories at the exact same time. On one hand, you hear about chaos, and on the other, you see total calm. So let's get into it and try to make sense of these conflicting signals. You know exactly what I'm talking about, right? You open up your newsfeed and it's just this constant barrage of fear. Energy bombs, geopolitical crisis, market collapse is right around the corner. But then you actually look at the markets, and the S&P 500 is just hanging out near its all-time highs. All the major indices are holding firm. The numbers just don't seem to match the scary narrative. So this leads us to the big question we're tackling today. Are investors just being dangerously complacent, just ignoring all these huge warning signs? Or are they actually seeing a deeper trend that the headlines are completely missing? To figure that out, we've got to start by measuring the real level of fear in the market.
All right, so to really understand this disconnect, we need a way to actually quantify fear. But as you're about to see, not all fear indicators are the same. Where you look for fear dramatically changes the story you see.
Now, if you look at the popular sentiment gauges, like the CNN Fear and Greed Index, the story is one of pure terror. I mean, it is deep in extreme fear territory. This tells us that the general public, the retail investor, is absolutely being sold a story of fear, and they are buying it, hook, line, and sinker.
But then we switch gears and look at the VIX index. This is what the pros on Wall Street watch. It's their fear gauge. And the picture is completely different. The VIX is nowhere near panic levels. In fact, it just hit a ceiling and pulled back. There is simply no panic here. This tells us the smart money is not buying the story of an imminent market collapse.
Okay, so if the big players aren't worried about the entire stock market, where is all this fear and anxiety coming from? Well, it turns out it's not spread out evenly. It's highly concentrated in one specific spot. And this table here lays it out perfectly. Public sentiment, extreme fear. Stock market volatility, the VIX, totally stable. But look at oil volatility, the OVX. It's high and it's trending up. This is where the real hedging is. This is where the pros are focusing their fear. It's like the market has put the risk in a quarantine zone, containing it to the energy sector, which is why the bigger market can just keep chugging along.
So, if the seasoned investors are shrugging off the scary geopolitical headlines, what are they really responding to? Well, it's a much larger, much quieter, and way more powerful force.
You see, for decades now, there's been this almost silent trend working away under the surface. Government debt has been growing, consistently at about 6 to 7% a year. Meanwhile, the economy, the GDP that's supposed to pay for all that debt, is only growing at 2 to 3%. Over the long run, that math just doesn't work. And this gap, this persistent gap between how fast debt is growing and how fast the economy is growing, it creates a phenomenon called monetary degradation. It's a fancy term for a really simple idea. The money in your wallet and in your bank account is systematically being devalued, little by little, all the time. And folks, this is the key to understanding the whole thing. Investors aren't ignoring risk. They are just hedging against a different and, frankly, more certain risk. The real bombardment isn't the one you see on the news. It's the slow, steady erosion of their cash.
So how do you defend yourself against that? You get your money out of cash and you put it into assets that can actually hold their value. You buy productive things like shares in the profitable companies of the S&P 500. You buy hard assets, things like gold, real estate, even Bitcoin. This is a huge reason why the stock market stays so resilient. People are using it as a life raft to escape a devaluing currency.
Okay, so now let's pop the hood on the market itself. If we look at how different sectors are behaving, we can see this whole dynamic playing out in real time, and it gives us some clues about what might be coming next.
So, what's the market's dashboard telling us? Well, the energy sector is strong, but it's getting a little overbought. The market's already priced that in. Bonds? They're stable. That tells us the bond market isn't freaking out about runaway inflation. But here's where it gets really interesting: the banks. Both the big Wall Street banks and the smaller regional ones are showing major weakness compared to the rest of the market.
Which begs the question, right? In a market that's holding up so well, why is the entire financial sector, the backbone of the whole system, lagging so far behind? Well, that weakness, that's the final piece of our puzzle, and it's pointing to a massive disruption that's just over the horizon. See, this weakness in the banks isn't just about some old-school credit risk or bad loans. No. This is about a fundamental technological threat to their entire business model, their whole reason for being. A new financial technology is coming up fast, and traditional banks see it as nothing less than an existential threat. And that technology is stablecoins.
I mean, just look at the difference here. It's night and day. Traditional banking operates on business hours and can take days to move your money. Stablecoins, they're 24/7, 365 days a year, and transfers are instant. Plus, they're a gateway to this entire global world of digital assets. This isn't just a small upgrade. It's a complete paradigm shift that could pull huge amounts of money right out of traditional bank deposits.
And you don't need a huge number for this to be a massive deal. I mean, think about it. If just 5% of all deposits moved out of the old banking system and into this new digital one, that would be an absolute earthquake for the financial industry. And the market, which is always looking ahead, is already starting to price in this risk. It's a huge part of why banking stocks are underperforming.
Okay, so after looking at all of this, from public fear versus professional calm, from monetary policy to technological disruption, what's the one crucial point you should take away from all of this?
Here it is. The market isn't being irrational. It isn't complacent. It's being perfectly rational. It's making a calculated bet against the biggest, most predictable risk of all, the slow, relentless degradation of money itself. The headlines are the noise. The slow erosion of your currency is the signal.
And that really leaves us with a final thought to chew on. Is it possible the greatest danger isn't in the loud, dramatic crises we see on the news every day? Maybe, just maybe, the real risk lies in the silent, powerful shifts that are happening right now, just beneath the surface.